Hey, Clint, thank you for so much for being here. We really appreciate it. I wanted to bring you on because last week we actually had a mortgage broker and they talked through what this rate increase means from the mortgage broker standpoint. I wanted to hear it from a financial planner standpoint. And so tell me, one, introduce yourself, tell us all about you, and then, let us know what's going on in the market right now.
Well, I appreciate you having me on, Robert. This is a crazy time right now. We've got all the rate increases. We've got a lot of things going on, but let me first, like many in my industry, I need to throw out a little bit of compliance, and that is, this is not a solicitation for sales or recommendations. The opinions are mine and not for Sigma Financial Corporation or Upstream Investment Partners. And that said, right now the market's going through a cycle just like it does anytime. And I've thrown a few slides out there for you, but one of them we've got right now is from JP Morgan that talks about and shows as the market goes in, there's several times a year that the market's down. And at the end of the year, it ends up much higher than what it ended, than the mid-year downturn. And you can even look back in 2020, 2008, 1999, some of those big drops, because in 2020, you can see where it was down quite a bit, 34%, but it ended up, in the mid-teens. So it's hard to say where we're going to be at the end of the year, but right now the market's doing what it always does. It adjusts. And since, the 1980s, I've heard it a lot of times. This time is different, and what you find over time is the markets are pretty efficient. They adjust the pricing, in the world economic events, pandemics, political changes, wars, all those are evaluating how does it impact. And this time it might be a little different because you've got a lot of folks that got into the market in the 2020 timeframe. And, some of them are now experiencing downturn for the first time ever. And so as you can see in this next chart, you've got things that really came out just tremendous, like, AMC. People picked it. They started they got all the bulletin boards and all this. And, from April 2020 to June 2021, it went up, over 1,700%, and so it's just crazy. But a lot of these folks they're picking stocks when they're real far down like they are now, but they've never seen it go up like it has and then experienced a downturn. So that's part of what's going on. And one of the things that I'd like is you hear your AMCs, you hear some of these others out there, but there was a retail stock that really did well. Do you have any idea of what did really well during that time frame?
No, I knew about AMC. Tell me about others.
Well, the next chart, as you'll see, you didn't get much publicity. I actually found out how it was doing through going to shop. But from April 2020 to November 2021, Dillard's was up 14% by showing, as you'll see on this chart here. And none of this stock or others, really didn't get the publicity that your AMC did because, the talking heads got out there on the AMC and all. But my point being, the market is going to adjust. It adjusted before, it adjusts historically, it'll adjust again over time. It's a matter of sticking to a regular routine overall and getting putting your money to work for you.
Okay.
One of the things I know that people are asking as well is about inflation, because of, we're in our like 10% range right now for inflation. What's going to happen with that? And the quick answer on any of that is it's going to be painful. It is painful. We've all seen it in gas prices. Yeah. But what you see with inflation is looking through what your wants and needs are as well. But what you will see with inflation, you might see another 20 or 30% decline in the market from where we're at. But when you're getting close to retirement, it's tough because you see that, how long do you have to recover through that? So it's kind of hard to pick an individual one stock or one investment that's going to help you through that. But what we're going to see over the next few months is We've had the 75 basis point increase. We should see a pullback in what's called M2, which is the cash that's out in the market, which was thrown a lot out into the market historically back in 2020. But you're probably going to see another, at least two, probably 75 basis points and another 50 basis points increase before the end of the year. So unfortunately, there's no easy letdown from inflation. Then what happens a lot of times is from inflation, you end up with a recession if it's gone too high. So is it going to happen now? Is it going to happen in 2023, 2024? It's hard to say. It's hard to say, but we will see inflation over for a while, because inflation, once it starts getting going, it's like a snowball. It just starts picking up things on the peripheral and going forward. So you'll see, the increases you see in gas, you see the increases in groceries, you see the increase a lot of times even in salaries, because although the standard rate for somebody to get paid, went from 8.25 for minimum wage, it was told that it should be $15 an hour. It wasn't enacted, but now people are going on I have to get at least $15 an hour, or I'm not even going to get a job. And that's what you're seeing a lot of businesses, come in through. So you're seeing it with the influx of people in this area. You're seeing the inflation that hits with the real estate. How's that impacting y'all's world?
Yeah, real estate it's interesting. There was a short-term slowdown. People are just thinking what's going on. And then I think a lot of people are looking up, and they're still, we're kind of plateaued. So there's actually great opportunities for both buyers and sellers. But I still think most people believe, and even people like Dave Ramsey and all them will say stuff of, this is going to be the best price you're going to get in the next 5 years. So everyone is still pretty heavy on buying real estate. What is the rate increase? How does that impact it more on your side?
Well, it's the rate increases. If you're invested in things like bond funds, the longer term bond funds, if you look at that, it's like a big, like a seesaw. As rates go up, the other end of the spectrum goes down. And so your long-term bond funds come down dramatically during rate increases. And it's really hard for them to price that in, because until they know how much it's going up, they're kind of guessing at where the rates will be effectively afterwards. But it'll be interesting to see how the market takes through some of this right now. But what I like with your area, with like the real estate here, is with all the diversity we've brought into the area, with e-commerce, medical technology, banking, all these things, with, the Dell hospital and stuff. It's just, there are so many great things that in this market, I agree that across the nation, it's probably about 4 or 5 years, but I really don't see much of an impact in this area too much, because we're so diverse overall. And I don't know if the statistics stays the same, but at one point I heard we were having like 150 people per day move into Austin. Is that kind of still what you're seeing?
Still the number. Yes, sir.
Wow. Well, so the next slide that you can look at, one of the things that increases will hamper overall is, how are people running their money? And basically, how's that going through? And if you look at consumer spending, in the middle right there, you'll see that we were, on a steady increase and started coming down over the last few years. But now, again, it's gone back up. I know it got, stated a few times about how we were going down on credit, but you can look, we're back up there again. And with the increase in interest rates, and our credit debt is back up there in the $800 billion range again, that's going to be scary to see what happens with some of this credit card debt, that instead of being 9 or 10%, might be 12 or 13% or more for some of these folks. So it'll be interesting to see what happens and how the consumer weathers this through right now. So, a lot of people ask us, what can I do right now? And again, I kind of mentioned earlier, you have your wants and desires, but you're still going to have your basics. You're going to have your food, you're going to have your housing, you're going to have your clothing. But what will happen is some of the the wants, like their trips. We found the new word staycation a few years ago, and so things like that will come back into the norm again, because airline tickets will become pretty expensive through this gas and through the rate increases, so that people will stay back. I mean, just the other day, it was announced that Williamson County Sheriff had already blown through 2022 fuel budget in June. So for the rest of the year, they've already spent all they were wanting to spend on fuel. So that's like a lot of consumers. Their budgets are blown for the year because all this increases that are incurring right now. I mean, I think you'll see a lot of spending cut back of extras that people buy, but they're still going to have to buy the gas. They're still going to have to buy the food, and that's still going to come out of their budget. So their wants and their extras will have to, take a hit on some of that. So we'll see.
Okay. So in your world, are people just buying bonds and stocks, or what does that look like?
Well, for this, it's hard for me to talk about an individual investment, but I will just say that value rated stocks or ETFs or mutual funds that look at value priced investments are pretty good right now. The market's efficient, and they'll price out the investments, but it does punish those companies that don't move with the market and in the areas it's going. But as I mentioned just a couple of minutes ago, with staycations and things like that, look at companies that benefit from that. I mean, your oil and gas companies are benefiting from the price of oil and all, and what they're earning on some of it. They're still going to have to make investments to get the numbers up there, but some of your staycation ideas might be a good way to look. But like I said, value is a great way to get some some returns right now. Reassess basically too where you're at. If you bought investments that you're still pretty strong on, you probably want to keep a hold of them. But if you're buying something because your friend told you to buy it, or it was a good quirky thing to buy at the time, reevaluate it and see if that's part of what you're doing. Talk to your advisor. Have them look at your portfolio and see if what you started as an investment 2 years ago is still a good one now. You have to reevaluate during this time. It's kind of like the Warren Buffett effect. Look at what you buy every day, and possibly look at those as being the things you buy for the future, because you'll still be buying the things you bought yesterday and in the future.
That's a good point. I love that.
So, yeah.
Well, Clint, I appreciate you. Thank you so much for sharing everything that you shared. I'm definitely a strong believer in who you hire matters. And having someone in your corner that you can trust and is an expert in their field, I think is amazing. I'm going to put your information up on the screen real quick.
Thank you.
Perfect. So again, thank you for being here. Any last comments or any thoughts?
No, I would just pray for our country, pray for our leaders, and just keep everything strong.
Absolutely, without question. All right, I appreciate it. Thank you so much, Clint.
Thank you, Rob.
Take care.